the US is going into a new phase come January 6th with the Trump administration, Trump 47, and what that brings with it. The notion of, I think, an aggressive growth in the economy is typically inflationary. That said, if you look at cost cutting and waste in one sector and being pushed, like, i.e. the public sector and people working deep within government and pushing those jobs into the private sector, the trade-off for that is you also get GDP growth as opposed to a cost from a government employee perspective. A private sector employee is creating growth within the economy. And if they can get that balance right where they're able to substantially increase GDP, that's going to help with the debt levels, which the US is obviously crippled by right now. And if the economy is expanding, it may well assist in making sure that inflation doesn't become the problem that it could be. Hey guys, welcome to this week's Money and Investing Show. This week we are looking at 5 stocks and sectors to watch in 2025. Clearly some major shifts at the back end of 2024 aligning markets for what could be an incredible year for certain sectors. We'll talk about exactly what sectors we like and why in the show. Make sure you don't just take notes, make sure you take action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my co-host and offsider, Mitchell Olarenshaw.
Always good to be here, Mr. B. Now, we're both getting excited for the year ahead, 2025. Gee whiz, what a year 2024 was for markets, right? I mean, huge run out of the equities as well as gold, other assets like that. But 2025...
Crypto too.
Crypto, absolutely. Post-election, we saw a huge rally. But what comes in 2025? What should our listeners be looking out for?
Well, there's a lot to digest, that's for sure.
Oh, yeah.
And I think, the way that these are all interrelated are based on probably one of the biggest things, which of course is the US election and what that determines for global trade and indeed the global economy. So that's massive in terms of the impact that it's going to have on our outlook for where we're at.
Well, let's start there. So before we go into what those sectors or stocks might be, let's talk about the economic backdrop that we're entering into 2025. Maybe we could focus US, Australia, given they're the main two stock markets we trade.
But I think inflation is a big one. There's definitely, and we've alluded to this quite extensively through this year's podcasts, that we're in a very different rate cycle for both. The RBA have held firm thus far through 24, and I called this ages ago. There's no rate cut this year. Everyone was saying, "Oh, the banks are preparing for a rate cut." It's not going to happen. The rate cut will be at the earliest, I suspect, going into the second quarter of the new year for Australia, because the economy literally is in a very, very different space. We've got extreme government spending and subsidies that continue to fuel that inflation. And while it may be drifting lower, it's still outside of the RBA's bands, and you want to see that sort of settle down. By contrast, the Fed have been quite proactive, a couple of rate cuts in, one big one and one smaller one, ahead of the election to sort of show where they're at. However, I think we're going to see a bit of a pause there now. We've seen comments already from Jerome Powell that let's see how these play out before we start cutting any further. And of course, you've got a new administration kicking off on January the 6th too, which is going to make a material difference. Economics-wise, outside of inflation, I think we've also had 2 tiers of growth where we've got an Australian economy which is teetering, I think, still toward a risk of a recession. And again, depending on government policy out of the US election result, we may well see China in particular slow down, which it has been this year, which will weigh very, very heavily on Australia, given the dependence we have on our trade relationship there. By contrast, the US, I think, is off to the races. It's
interesting here in Australia, too, just to flesh that out, AB. I mean, resource stocks haven't, without wishing to date this podcast, been performing very well at all. On the other side of the coin, you've got cyclical stocks in the financial space, the big banks, which have done immensely. I mean, CBA today is trading at $156. I remember looking at it at $100, thinking it was expensive. So there's been a massive run out of the big four. Why is there such a stark contrast in Australia? Because, I mean, effectively 2/3 of our stock market is made up of banks and resource stocks, right?
Look, I mean, from the bank's perspective, higher interest rates are always good for banks because that margin between the lending and the borrowing rate are very different. What the bank acquires money for versus what it then lends on to. So having a higher level of interest rates has meant that they've been able to fatten the goose quite some there. And also, thus far, we haven't seen any real weakness in the property market in terms of a significant downfall in prices. There's been stuff in different suburbs, by and large, has been fairly reasonable. And so, the banks are in good order as far as that's concerned, reflected through their share price. I think the guidance and outlook is also quite interesting from the banks, which they've pointed towards, maybe not so much CBA, but a couple of the other banks when they reported sort of pointed out more difficult operating conditions ahead and some provisioning and things like that. So that's been on one side, but yeah, they've done well. The resources, yeah, we're very heavily tied to China, and China's had a significant slowdown. There's been substantial government assistance to prop up its equity market, its property market, and its overall economy. But demand for commodities and commodity prices on the back of it have suffered some. And that's the vulnerability that we have with our resource-based economy, particularly in our iron ore space.
Totally. And as you say, such a stark contrast between Australia and US. In the US, for example, we've seen some extremely strong economic data. Jobs are up, unemployment is lower. We've seen retail sales higher, consumer confidence at a 7-month high. They're flying over there. I mean, we were talking about soft landing, hard landing. There's probably no landing whatsoever.
Yeah, that wheel's up at the moment, that's for sure, and likely to stay that way on a new administration. And that dichotomy comes down to a number of things. We've got a very narrow band of markets that contribute so much to, or a disproportionate amount to our economy, whereas in the US it's genuinely a global player. And under a new administration, I suspect there are going to be some big changes, which I'm sure we'll talk to in just a few moments' time. But it's been a good, strong performance from the US economy. Consumer spending in particular a couple of months ago started to look a little bit shaky, but the consumer's back, and that is such an important spinal cord, if you will, for the strength of that economy.
Well, let's get stuck into the meaty part today. In that case, 5 stocks or areas, sectors to watch. I think number one, how can we go past tech and the AI revolution, right?
Look, exactly right. And some of the stocks, got belted a little while ago. You think about NVIDIA, is it the second coming now? I suspect it more likely is than isn't. And the question I typically have with clients, and I did a presentation recently about NASDAQ investing, and it was an older generation room, and they were a little bit sketchy on the whole thing. They didn't seem that enthused. They want your blue chips and your fully franked dividends. And we went round and did that straw poll of where you live. What do you do right now? What services do you engage with? They're all in the tech space or NASDAQ listed. So not just AI, which I do think is going to become an increasingly significant part in the global economy going forward, but also companies that have jumped very, very heavily on the expectation of their AI performance enhancements need to start delivering on the back of that too. And we saw some job shedding in tech when AI was really coming to the fore, probably a quarter, maybe 2 quarters ago now. And I think we might see a little bit more of that coming from that space as more and more stuff gets automated and pushes through to what the bottom line looks like for those companies, because their wage bills are pretty high in that sector as they acquire talent. So I think technology across the board is still likely to be a strong play for the year ahead, which will be its 3rd in a row. I think the NASDAQ delivered something like 53% in 23. I'm not sure what the figure is going to be altogether for this year, but it's certainly going to be substantial. And maybe we see a 3 in a row coming from the year ahead. Maybe a little bit more selective. There might be some laggards that are in there that get punished for failing to deliver. But by and large, it's not going anywhere. It's part of the future. As
you say, I think the biggest risk in that sector is that their expectations are up here. And even though they might deliver above the odds results, if it's not quite at the expectation or the level that everyone thought it was going to be at, it's still classed as a failure. But let's face it, they're becoming ever more efficient, and their margins can be, in some stages, really, really thick. But everyone is expecting them to, literally redefine the pathway and the world.
Well, you go back and you think about companies like Amazon. I think, was it 96 or 97 Amazon was founded? So this is a company, relatively speaking, which is in its infancy. Yeah. You compare that to, say, Apple, which is sort of early mid-70s, which is a little bit older. And yet you've got other companies that are these stalwart dinosaur almost businesses. GE just had a nice profitable trade out of GE.
Nice one, I did see that.
But these industrial conglomerates are businesses of yesteryear by comparison. So these are new businesses, and like it or not, they have redefined the way that people live, and in many respects in a good way. We look at the pandemic and how those tech companies helped us through there, but just the innovation and move forward of where and how society live. If you think particularly pacing this forward into sort of biotech in particular, that ability to self-diagnose, to do your blood pressure or even an ECG from your watch is mind-blowing. What comes next? What have these guys got lined up for us?
I guess that's the thing, right? You don't know what you've got. You don't know what you're going to get until you've got it.
No, but it's going to be worthwhile. It's going to be valuable. And that's what, when you pay 30, 40, 50, 60 times earnings for a stock, that's what you're paying for, is that slice of whatever the future may be, whether that comes out of Cupertino or where else in the US it comes from, but it's there.
Very nice. Moving on to number 2, one that we've spoken of extensively this year is the bond market.
Yep.
Yields versus prices, AB.
Tricky one. We had a very clear view, certainly on what we expected out of interest rates, which had started, and I suspect is going to stall. What I mean by that is I think the pace of cuts from the Fed is going to slow down some, which means that bond yields don't necessarily fall, bond prices go up. We're quite heavily exposed to bonds right now, and the advice to clients in that space has been very clear, and that's to be writing calls over that position just to chip away, get your costs down, and get some income from it. The US is going into a new phase come January 6th with the Trump administration, Trump 47, and what that brings with it. The notion of, I think, an aggressive growth in the economy is typically inflationary. That said, if you look at cost cutting and waste in one sector and being pushed, i.e. the public sector and people working deep within government and pushing those jobs into the private sector, the trade-off for that is you also get GDP growth as opposed to a cost from a government employee perspective. A private sector employee is creating growth within the economy. And if they can get that balance right where they're able to substantially increase GDP, that's going to help with the debt levels, which the US is obviously crippled by right now. And if the economy is expanding, it may well assist in making sure that inflation doesn't become the problem that it could be. Equally, under those policies, tariffs don't necessarily have to be inflationary either. We talked about this in our post-election wash-up. They can be used in a stick and carrot fashion, and I'd advise people to go back and have a listen to that podcast if you're not sure what I'm talking about there, to have not more expensive goods being imported, but using it as a stick to beat companies to actually manufacture in the US, which is not inflationary. The big one that we'll be watching for, which will give us a good proxy on bonds and inflation, is what happens with energy prices. And if 47 is able to get that liquid gold pumping and get oil prices down, energy prices down, that is a very, very effective way of taking a lot of heat out of the economy from an inflationary perspective, which then paves the way for the Fed to cut rates further.
So assets to trade this, we know TLT or TMF are your long bond price ETFs.
Yep.
If
on
you
the
want
other
to get
side of the
exposure.
question, you could be looking at TBT, for example,
For bond
instead,
yields.
which is the bond yield, yeah.
Got you. Both which have options as well, heavily liquid assets, which we trade all the time.
Correct, yeah.
Number 3, AB, one that's been a good area of interest for you the last year. I think you had a pretty rapid trade on this, correct me if I'm wrong, was the emerging markets.
That's right. India in particular, it's been a great one. PIN is an exchange traded fund that we've had exposure to. We just literally stopped out of that about a week or so ago.
Nice profit.
Yeah, great profit. We're in from about 20. We got out at 24.50, back in at 24.50 and out at 28.50 at the moment.
Nice. Looking
for another buying entry into it. India is an interesting one. Obviously, they had their election earlier in the year, which saw a bit of volatility in the market, and the index ground a little bit higher, and it's just stalled a little bit. So the shape of that market's changing a bit just now. I don't think long term it will be. This is just an opportunity to buy back in, hopefully at slightly lower levels on that retracement. India is an interesting one because it's also, out of most of the Asian countries, it's probably the one that's the least vulnerable to big tariffs in China and a slowdown in the Chinese economy, because China's not that big a trading partner for India. So it's relatively insulated in that part, and be very, very interesting to see. But I do think emerging markets do represent value across the board. We talked about Mexico some time ago. I think the mandate from Trump 47 will be less friendly towards manufacturing in Mexico and actually manufacturing directly in the US. I think he's made it very, very clear that's what his intention is. So that trade is now off the board. But India, I think, I'm definitely looking for another opportunity to get back in.
Any other emerging markets across shores that you see fit?
I think it'd
or
be
an ETF for emerging markets as a whole?
Look, you can be across emerging markets as a whole. I think a couple of things that would probably help the case for emerging markets would be a removal of some of the conflict in the world right now, which is huge and weighing very, very heavily, and also some clarity of handover post January 6th as to what a tariff policy might look like. And it may be that all countries get belted with a really heavy tariff, or those that the US wants to sort of bring to heel are the ones that get hit pretty hard. There are emerging markets which you deem as being friendlies towards the US that might get more of a concession. Some of the other Asian countries, particularly, might be beneficiaries of not getting clobbered with a full tariff, but time will tell on that. So there's a little bit of element of risk on there just at the minute, and so I'm keeping things fairly tight there.
Very nice. Moving now to number 4. This one is relatively traditionally a boring sector, very defensive, and that's healthcare. Why is it an area of interest, AB, for 2025?
Look, healthcare has been a mainstay of the election campaign with RFK Jr. joining from the Democratic Party to the Republicans, and as a consequence of that move is going to have a fairly significant say in healthcare policy in the US. And there's two things in that. Things have to change. I get that totally, and we can articulate that in some detail in a moment. But they're not going to change quickly. You know, you've got an ingrained system of not that healthy eating, a reliance on big pharmaceutical from a so if you don't eat well, you end up with a medical condition which you're able to then get a prescription to fix, which becomes this vicious circle of profitability in those sectors. And that's going to be a very, very difficult battle to fight. But long term, if you can get things squared away at a primary production level, whereby you reduce chemicals that go into food production and have a more natural, less GM type product that's coming into your food chain, the longer term benefits of that are key. The other aspect of it, people are living longer, and living longer means there's a heavier reliance on healthcare too as you get into your more senior years, and so there's an opportunity in there for potential investment. But the time frame on this is a very, very slow moving type place. I mentioned earlier when we're talking about technology, and it's a subset, I suppose, of both tech and healthcare, and that's biotech. And I think that's an area that's going to continue to be ripe for picking. Just got to be in the right stocks, of course. XLH
is the broad market healthcare ETF too, by the way, if you want to take out the stock specific. Otherwise, companies like Pfizer, Bristol Myers Squibb, I mean, these are stocks we trade all the time in that space, right?
Big Pharma will be interesting. I mean, there's going to be a lot of rhetoric initially, and it'll be interesting to see the pace of change, and I think it's going to be, despite how hard it gets pushed from a government level, will be glacial in terms of how slow it will be, because it's such an ingrained part of the US economy. And anecdotally, you see that. I mean, you've spent some time in the States. I've also spent quite a lot of time in the States, and you know, it's just advert. Are you bloated? Are you overweight? Do you have a heart condition? And then it's surrounded by adverts that are pushing, products for you to eat or consume that's going to ensure that you continue to have those particular maladies. So it's a real breakdown of that that sort of food, pharmaceutical, industrial complex, which are inextricably linked. And I don't think you're going to see that in 4 years. But
interesting. And last but not least, number 5, one that we've spoken of prior to, was homebuilders or home building.
Yeah, I guess one of the mandates that was discussed in the election run-up, and I guess these are all provisos if you can deliver on that you talked about to get elected, which is always an interesting...
The biggest question, right?
It is.
The intention.
The intention was there.
The intention.
We intended to do that, but we never quite got there. I think... You know, the advantage the Republicans have got is they've got control, and a very, very firm hand on control with both the House, Congress and Senate. So, that's really, really important. The removal of red tape in particular, I think, is crucial for house builders. And the US property market has been pretty reasonably stable. Part of that, of course, is that there hasn't been a huge supply coming in. If you are an existing homeowner, chances are, and lessons the US learned, we've talked about this plenty of times before, you're probably on a 30-year fixed mortgage at maybe 2 or 3%. Now, if you were to buy a new property, you've got to refinance it, probably 6%. It suddenly becomes not that attractive. So that is a factor that's there that's maybe sort of slowed things down in transactions there. The other issue is if you look at housing approvals and the housing starts in the US, it's been on a fairly steady decline over the last 3 years. So turning that around and saying, like, let's start new supply, let's cut the red tape, let's start building is likely to be, a good catalyst for that sector. The stocks like Lennar or DH Horton,
Home Depot maybe, HD.
DR Horton, DHI being the code. They're sort of areas that you might want to consider if you're individual stocks, or XHB is the house builder ETF. And again, that's not likely to be that quick, but it's going to be a change in trend, which coupled with lower interest rates is one that's likely to be quite solid. And I guess from an economics perspective, rebuilding your economy, and we know from Australia, for example, that when you put money into the property sector, the building space is a significant multiplier elsewhere. And if that's your intention in the US, if that's an area where you take the hand off the tiller and say, right, we'll reduce red tape, start building. There's not a government subsidy to build, but you just make it more available for that to happen. You do get growth without getting the overshoot that we've had in Australia, where there's been too much money thrown at something and it's overcooked itself. So I think that's going to be a really interesting one to watch. Again, it comes down to, we got elected, these were our intentions versus this is the deliberate actions that we're going to take.
All right, now I'm going to throw a curveball at you. We haven't prepared for this or spoken about this at all. The wild card. The special situations wild card. We've gone through 5 sectors, one more.
I think that there's probably 2 that are fairly inextricably linked.
2? Yeah. Okay.
One is defense. The US has been in a situation for military spending where it's been spending a lot of money elsewhere. Obviously it's been supporting a war in the Ukraine and also backing up Israel's defense of itself against its neighbors. And so, there's been some spending there. But there's also been a lot of cuts there too. If we look at AUKUS, the submarine deal between the US, the UK and Australia, we're supposed to be getting a submarine. The US's fleet, they need 66 submarines, they've got 17 at the moment, and the Biden administration cut annual production of submarines from 2.3 to 1 a year. We might see that faucet opened up where there's a big surge in defence spending to ensure a strong and robust America, on the back of which diplomatic relations with countries that over the last 3.5 years have basically thumb their nose at the US. So you could see that with the relationship between Netanyahu and Biden, where it's like, listen, we're doing this. Well, we're not going to be pulled into line. A strong US, a strong military US is likely to see that pendulum swing back a little bit. And just to show how the US is really sort of drifted in terms of world opinion, there's a terrific photograph from the G8 summit over the weekend. And in the back row on the right-hand side is Joe Biden, not front and center, which is where the US really should be, next to Xi Jinping, for example. And I think that military spending and beefing up that particular aspect of your defense and economy is one area you can see it. The other one is energy. And I think not so much in terms of the profitability for oil companies, because lower oil prices don't necessarily translate into profitability, but for a lot of oil services companies like Halliburton as an example of that, that provide the bits and the gubbins that sit behind exploration, fracking, pumping and all that sort of stuff. Again, if Trump 47 is about getting that black gold flowing, then I think those oil service sector type businesses, the support companies, are likely to be an area where you're going to see things go pretty hot pretty quickly.
Very nice. AB, great little insight today.
Nasty wild cards. I didn't think.
Sorry.
Yeah. Making me work for my money here.
That's right. Yeah, absolutely. Had to. I think there's lots of benefit in there for our listeners. So keep it on your radar. 5 stocks and sectors to keep an eye on.
It's going to be an interesting year ahead, and that starts very early in January. Remember, it's going to take time for these policies to kick in, but they'll lay out their mandate fairly quickly, and we don't have long to wait to see that.
Beauty. Bring it on, AB. Thanks.
Thanks, Minna. Cheers. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.